Welcome to the deep dive. Today we're really digging into a fascinating company, Balkrishna Industries Ltd, BKT as most know them.
That's right, a global leader, a real giant in the off-highway tire world.
Exactly. And we've got their latest results, Q2 and H1 for FY26. But what's really caught our eye is this huge, ambitious, long-term plan they've laid out.
That's quite something. We're talking a target of 2.2 times revenue growth by FY30. So the mission today is to sort of unpack how they plan to connect those near-term financials with that massive long-term vision.
Okay, so set the stage for us. Who is BKT today?
Well, they're already a very significant player, India's #1 OHT exporter. They sell, get this, over 3,600 different types of tires, skewed use across sectors like agriculture, mining, construction, you name it.
Wow, 3,600.
Yeah, and they sell these into more than 160 countries.
Hmm.
So we're looking at a company that's already, globally dominant in its niche,
Hmm.
but is now looking at a major transformation.
Right. Okay, let's start with that near-term picture then, because the H1 FY26 numbers, the standalone ones, they do show a bit of a slowdown, don't they, after a period of really strong growth.
They do. You see it in the sales volume first. For that first half of FY26, volume was 150,916 metric tons. That's actually down 4% compared to the previous year.
Okay, down 4%, and revenue.
Revenue followed pretty closely, down 2% year over year, landing at Rs 5,079 crore. So, slight dips.
Yeah.
Noticeable, but maybe not dramatic on the surface.
But wait, the number that really jumps out looking at the source material here is the net profit. That seems to have fallen quite sharply.
Yes, that's where the real story is in these H1 numbers. Net profit dropped 33% year over year. It came in at Rs 552 crore compared to, what was it, Rs 827 crore in H1 of FY25. That's a significant fall.
33%. Okay, so it wasn't just volume going down slightly. This looks much more like a margin issue.
Exactly. That's the key takeaway. The pressure was primarily on margins. Their EBITDA margin, that's earnings before interest, taxes, depreciation, and amortization, it contracted quite a bit.
How much?
By 286 basis points, it settled at 22.7%.
Right, so for you listening, 286 basis points is 2.86 percentage points. That's a fair chunk out of their core profitability. What drove that pressure? Was it raw materials? Demand?
It seems like a mix, definitely volatility in raw material costs, rubber being a big one, of course,
Yeah.
and probably some demand normalization happening in key global markets after the sort of post-pandemic boom.
Okay, so profits are down significantly, but you mentioned earlier they have this ambitious expansion plan. How does that square? Does the underlying business still look strong despite this profit dip?
That's the crucial question.
Yeah.
And yes, when you look past the profit line, the fundamentals seem robust. You check the balance sheet. As of September 30th, 2025, BKT had gross cash and cash equivalents sitting at Rs 3,159 crore. That's a lot of cash on hand.
Okay, a strong cash position. What about cash generation?
Even better, their net cash from operating activities for H1 FY26 was Rs 1,254 crore. So despite lower reported profits, the actual cash flowing in from the day-to-day business is still very strong.
Right, so that suggests this is more of a temporary margin squeeze, perhaps, rather than a fundamental issue with the business model itself?
I think that's right. It points to a resilient operation that can generate cash even when facing headwinds.
Okay, let's look at where that resilience comes from. Where are the sales actually happening?
Good question. The breakdown is interesting. Agriculture is still the biggest piece of the pie, making up 58.2% of sales. Then you have OTR, off-the-road tires, think mining and construction, that's 38.1%.
And how are they selling these? Directly to manufacturers or to replacements?
Mostly replacements. The channel mix shows 71% of sales come from the replacement market. That's generally higher margin than selling to the original equipment manufacturers, the OEMs, which only account for about 27.7%.
So higher margins in replacement, but maybe more cyclical exposure.
That's the trade-off, yes. You're more tied to fleet maintenance cycles and inventory levels globally.
And speaking of globally, where are these sales geographically?
Overwhelmingly international. Europe is the biggest region at 39.2%, and the Americas are right behind at 34.9%.
Wow, so combine those. That's almost 75% of their sales coming from just Europe and the Americas.
Exactly. India, their home market, is only about 14.9%. So, BKT is very much an export-driven story.
That feels like a significant concentration risk, doesn't it? Relying so heavily on those two regions. What about currency fluctuations, geopolitical issues?
It absolutely is a risk, and it highlights why their operational strength and efficiency are so critical. It's what allows them to manage that external exposure and still plan for growth.
Okay, let's talk about that operational foundation then. What are the key competitive advantages that let them ride out these near-term challenges?
Well, probably the biggest one is their vertical integration, especially in carbon black,
Right, that's a key ingredient for tires.
a crucial one. And BKT produces a lot of its own carbon black. This makes them less dependent on volatile external suppliers and helps protect their margins comparatively. Gives
Right.
them more control.
And just sheer scale, right? Their production capacity is enormous.
It is, and they keep expanding. Once the current capex cycle and some debottlenecking are done, they expect their total achievable capacity to hit around 425,000 metric tons per year.
Just pause on that number. 425,000 tons of tires annually. That's huge. It helps understand how they service global demand.
It really does. And that capacity is backed by a very wide product range, over 3,600 SKUs covering really niche stuff too, like tires for mining, ports, even lawn and garden equipment, and ATVs.
And it seems like their quality is recognized by major players. You mentioned Caterpillar earlier.
Yes, they received Caterpillar's excellence level recognition, and importantly, for the fourth year running. That's a strong endorsement from a very demanding customer.
That speaks volumes.
And they're investing in maintaining that edge. They just opened an advanced vehicle dynamics and testing base at Natrex in Indore. So R&D is clearly a focus.
Plus safety credentials.
Yeah, the Booch plant got a 5-star grading from the British Safety Council for occupational health and safety. And they've reported 0 fatalities across the company for the last 3 financial years, which is commendable in heavy industry.
Okay, and then there's the brand building side, high-profile sports sponsorships.
Right. Official tire partner for the Copa del Rey final in Spain. Naming rights partner for Cricket Australia's series against India. It shows they're serious about building global brand recognition beyond just the industry insiders.
Okay, so strong foundations, vertical integration, scale, quality, R&D, safety, brand building. It paints a picture of a company built to last.
Precisely. And all of this really underpins the main event, the future strategy.
The big one. That target of 2.2x revenue growth by 2030, aiming for around 23,000 crore. That needs, what, something like a 17% compound annual growth rate? That's very ambitious.
It's extremely ambitious. And it's backed by a hefty Rs 500 crore capex plan.
So how are they planning to deploy that capital? What are the main drivers, the pillars of this growth?
They've laid out a clear 3-pillar strategy, with each pillar contributing differently to that future revenue target.
Let's break them down. What's pillar one?
Pillar 1 is essentially OHT segment consolidation. This is about doubling down on their core business. It's expected to account for about 70% of that future revenue.
So consolidating their leadership, what does that mean specifically?
The goal is to push their global market share in OHT up to 8%. Key focus areas are sustaining leadership in ag tires and really accelerating growth in mining tires.
Mining seems key.
It is, especially because they highlight being the only Indian maker of all-steel radial technology up to 57 inches. That's a big differentiator for heavy mining equipment. They're also expanding their facility for specialized rubber tracks, with production expected in the second half of FY26.
Okay, core business growth. Pillar two.
Pillar 2 builds on that advantage we discussed. Carbon black expansion. This is expected to be about 10% of future revenue.
So deepening the vertical integration.
Exactly. They're boosting their carbon black capacity significantly, from 200,000 MTPA now up to 360,000 MTPA by early 2026.
And this isn't just about supply, right? There's an energy angle too.
Correct. Part of this investment includes adding another 24 milliW cogeneration power plant. This brings their total cogen capacity at the Booj facility to 64 milliW. It's about energy efficiency, circularity, and keeping production costs down. Very smart.
Okay, pillars 1 and 2 seem like natural extensions of their current strengths. But pillar 3, this sounds like the really big strategic shift.
It is. Pillar 3 is entry into new tire verticals in India. This is the bold move, targeting around 20% of their future revenue.
And these new verticals are?
They're entering 2 massive, high-volume domestic Indian segments: commercial vehicles, radial tires, CV radials, and premium passenger car radial tires, or PCR.
Wow, okay. So the company making giant 57-inch mining tires is now going to compete for tires on, everyday trucks and passenger cars in India. That's a huge leap.
It's a massive strategic pivot. They're taking their global industrial expertise and aiming it squarely at the Indian consumer and commercial vehicle market.
But that domestic market is incredibly competitive, isn't it? Dominated by well-entrenched players. How realistic is targeting 20% of revenue from there?
It's definitely the most ambitious part of the plan. They're targeting about a 5% market share in these new CV and PCR segments. It's a big ask.
So how are they approaching it? Are they just diving in?
No, they're being quite methodical. This is a modular entry. The CB radial pilot is launching quite soon, Q4 FY26. Then the premium PCR pilot follows in Q3 FY27.
So pilot programs first, testing the waters.
Seems like it. Leveraging their existing brand recognition, hopefully, and their reputation for manufacturing quality, and seeing how it plays in these very different domestic segments.
That 5% market share goal in CV and PCR still feels like the crux of the risk here. Can that global OHT excellence translate directly to winning over Indian truck drivers and car owners?
It's the billion-dollar question, isn't it? Or rather, the Rs 3 to 500 crore question. And this is where maybe the ESG and corporate responsibility side of things becomes more relevant than just ticking boxes.
How so? How does sustainability performance support this kind of market entry?
Well, building trust is key when you enter a consumer market. They're improving ESG scores like the S&P Global score jumping 11 points to 53 helps build that narrative.
Okay, what specific ESG highlights support this?
On the environmental side, the high recycling rate, 98.17% of waste recycled or reused, is strong. And that significant reduction in non-renewable grid electricity use, over 21% year over year, shows commitment, especially while adding power capacity. It speaks to efficiency.
And the S is in ESG, the social side.
The zero fatalities record over 3 years is obviously paramount, but also their corporate social responsibility efforts, donating robotic surgery systems, supporting cancer care, the midday meal program for thousands of children, promoting inclusive learning. These actions build goodwill and brand reputation. That matters when you're asking consumers to choose your product.
Right. It helps position them as a responsible, quality company entering the domestic space, not just an industrial giant.
Exactly. It contributes to the overall brand perception.
Okay, so let's try and summarize the key takeaway from you, our listener. BKT seems fundamentally strong, despite a recent profit dip that looks more like a reflection of global cost pressures than internal weakness.
Definitely. And that underlying strength, especially the strong cash flow, is now fueling this real. And the expectation is that once this new capacity is fully up and running, their blended margins should recover nicely back into that healthy 23–25% range.
Absolutely, but it really does feel like everything hinges on Pillar 3, doesn't it? Right now, BKT is overwhelmingly about global OHT sales, over 70%.
Yeah.
So targeting 20% of future revenue from the hyper-competitive Indian market for car and truck tires, that's a huge bet on translating their global industrial reputation into local consumer appeal.
It really is. And maybe that's the final thought to leave you with. Think about this. What happens when a company recognized for excellence by someone like Caterpillar, who needs incredibly reliable tires from massive earth movers, tries to sell tires to everyday Indian consumers and trucking fleets?
Can that same reputation for precision and durability win in a market often driven by price and very different performance needs?
It's a fascinating test. Can that industrial excellence translate effectively into the mass market? Will Indian drivers trust the mining tire giant for their hatchback or their delivery truck? That's the question to ponder as BKT starts rolling out these pilot programs.
A great point to consider. We'll certainly be watching BKT's journey closely here on the Deep Dive. Thanks for joining us.